according to my next guest, who says a gold rush by China could catapult the price to as high as $2,600 an ounce. He's David Rosenberg, chief economist and strategist with Gluskin Sheff and Associates. Great to see you again, David. Thanks so much for joining us.
It's great to be back.
So you think that the fact that we're seeing some central banks buy gold, whether it's India, Sri Lanka, you've got central banks now out vocal about buying gold, that changes the story?
Well,
as far as why to buy gold?
Well, it's one of the reasons. I mean, look, these central banks were one of the reasons why, when they were selling gold en masse, that drove the gold price down to $250 back in 1999. And, here we are a decade later. The price of gold has gone up by a factor of almost 5. And only now are they starting to discover gold as diversifying in terms of the sheer reserves. But, look, you take a look at the situation in India. All they did was they went from 4% of their foreign exchange reserves in gold to 6%. On the eve of the Bob Rubin strong dollar policy in the mid-90s, they were as high as 15%. And you look at China, and only 2% of their reserves are in gold. So, when people are talking about, well, who's going to be the buyer of gold? Well, it looks like the central banks now, who have their gold reserves at unprecedented lows, are going to end up being the big buyer. And don't forget that there's the demand side. But what about the supply side? I mean, when you take a look at mined production of gold, it peaked a decade ago. And I think that one of the primary drivers of gold, it's not that it's a hedge against inflation or deflation. It's not a complicated story. Gold production has been stagnant for a decade. And yet when you take a look at the production of fiat currency, by the way, you mentioned gold hitting $1,200 an ounce.
Right.
Gold's going up across every currency. It's not just against U.S. dollars. And every country, to varying degrees, is massively fiscally stimulating their economy, monetarily stimulating their economy. So it's not just dollars, but the production of global fiat currency is up 150% over the past decade at a time where there's no production of gold.
So you think that given the supply-demand situation that there are also reasons to support a further move up? It's gone up significantly in a short period of time. Do you think we'll be able to get gold at better prices before this run-up resumes?
I absolutely do.
So first it goes down and then it goes up, is what you're saying.
Well, you're right. Well, look, are you asking me, do I think that we'll get a correction? Part of this, of course, in U.S. dollar terms, the bear trade in the dollar, and I've been bearish on the dollar, but it right now is the most overcrowded trade that there is out there. So I'm a little concerned for the commodity space in general, and I'm still long-term bullish that we could get a, shall we say, a counter-trend rally in the U.S. dollar that causes a lot of these securities or assets that have been benefiting from the dollar carry trade or pricing dollars to correct. I'd be looking to get in a better entry point into gold right now on a short-term tactical basis. But is the long-term trend in gold, in precious metals, and in fact in commodities, has been up for the past 10 years, and that trend is still going to be going higher for probably the next 5 or 10 years. What
about equities here, David? What do you want to be doing in terms of 2010 for a strategy on stocks?
Well, I think that the problem here is I still believe one of what's being priced in. You don't have to have a double dip scenario in your forecast. Right now, the equity market's priced for 4.5% to 5.5% growth next year. The consensus on GDP is more like 2.5%. So all the strategists are all bullish, but yet the economists are roughly 2.5% growth. That means at best a sideways moving market. But I think at this stage, based on what's priced in, more downside than upside for 2010.
And the sectors that you want to be exposed to going into 2010 after this run-up, or what do you want to avoid?
Well, I think that, in terms of what you want to be in a very, I think, sluggish environment, not a double dip, but certainly an economy that's going to underperform expectations next year, you want to be out of the sectors that really did well this year, and that are your small caps. Those are your high beta, very junky names. I think you want to stick with what's actually worked ever since the S&P hit the 1100 mark for the past 6 weeks. The leadership has really narrowed to those blue chip, dividend-paying companies that have a global footprint. That's where I'd want to be situated next year, and maybe a little more on the defensive side, a little less on the cyclical side.
I see. Other commodities, along with that call on gold, do you think that we're also going to see money move into other commodities? For example, do you want to do platinum? Do you want to do silver? Do you want to do oil along with that move in gold?
Well, they've all moved for different reasons. I mean, gold is being viewed right now as a currency. It doesn't really have any industrial use. I think that, as I said before, I think that gold is going to be moving based on its own particular set of supply and demand curves.
Right.
I think that it's not going to be a straight line, but look at, if the experts are right that the strongest growth region in the coming year is going to be China and India, that's all you really have to know from a demand perspective as to where commodity prices are going to be going. So I think the trend is going to be up, and I'm bullish on the group in general. I think I'd be expecting a near-term pullback, but I think that next year, irrespective of my, shall we say, tepid call on the U.S. economy,
right,
really what's the driving force is going to be whether or not China and India can maintain the growth rates that they've reattained ever since the commodity complex bottomed at the beginning of the year. And I think there's a bull case for the commodity sector next year, pretty well across the board.
I suspect we'll be talking about China and the growth levels for some time to come. David, great to see you as always. Thanks very much.